Please stay tuned after the conclusion of the podcast for additional important information. Tariffs, Technology, and Transition. That's the title of PIMCO's latest Cyclical Outlook, which we published October 1st, and also the subject of today's conversation. I'm your host, Greg Hall, and today on Accrued Interest, really excited to have one of the authors of that piece with us, Tiffany Wilding, who's a macroeconomist at PIMCO and runs the Cyclical Forum process. Tiffany, thanks for joining us.
Yeah, thanks for having me. It's great to be back.
Yeah, we had you in April, right?
I think it was right after Liberation Day, right after those tariffs were announced.
It was that week. Everybody was running around, trying to figure out what had just happened. I think we had you and Libby on talking about the politics and the economics of that, right?
Yeah, that's right. It feels like it's like a lifetime ago already. But yeah.
Yeah, or 5 minutes.
Yeah,
it depends
exactly.
on your perspective. But markets have obviously done a lot since then, and we'll get into that. We also have Brandon Kunz. And Brandon is an account manager for us in the Dallas region. Dallas and Northeast Texas. Is that right, Brandon?
Yes, sir. Yeah, happy to be here as well.
All right, representing the great state of Texas and all the terrific financial advisors in your neck of the woods. And as always, you're here to make sure that their questions get answered as we move through today's discussion. Brandon, I'll just mention, Brandon has an extraordinary gift for making the complex simple. And he's somebody that I turn to pretty frequently when I'm going into a client session and I want to figure out a way to express what I think is maybe more complicated than it actually is. And Brandon usually helps me through that process. So Brandon, hopefully you can do that for us on today's discussion. I know Tiffany can make things as complex and complicated and esoteric and intellectual as she wants, given her level of expertise, and we'll be here to help maybe try to bring that down to a level that you and I can appreciate and take away. So with that, Tiffany, tariffs, technology, and transition. Do you want to set the stage for us for a few minutes here, and then we can get into some questions?
Yeah, I mean, so with that title, we're basically trying to convey that we really see the not only the U.S. economy, but the global economy really dealing with a clash of three economic themes right now. And two of them are policy related, and then the last one is more organic. But as you mentioned, it's trade policy and big changes in trade policy that have come out of the United States. It's technology and the rapid diffusion of new technologies, including AI. But it's also transition. And by transition, what we really mean is that the Trump administration, they ran and won on basically pivoting the U.S.'s role within the global landscape, both on trade and on capital flows, and in the geopolitical sphere as well. So we're seeing pretty major transitions in how the U.S. is viewed by our global partners and how we're behaving within the global markets. So in past cyclical forums, we've talked a lot about this. And in the past, we've argued that some of these relationships that the Trump administration wants to change. We've interpreted some of their goals is to reduce the trade imbalance and reduce the trade deficit in the United States. We've argued that these things, it's not solely about trade. It's about deeper issues within economies, more structural issues within economies. Economists will tell you it's savings and investment relationships, but the non-wonky thing to say is that these things have been influenced by regulatory policies, by fiscal policies, by industrial policies over the last number of decades, and that's why you see the global trade imbalances that you do. And of course, that's going to be difficult to change overnight. And as a result of that, it could be disruptive. There could be more volatility. And we had argued in the past that there would be some constraints there, right? People would not want that volatility. You'd have political implications, market implications, et cetera. But really what we've seen since then is that the administration is very willing to take in a maximalist approach. So they're trying to break through these constraints. And as a result of that, we've gotten major changes in trade policy. a number of trade agreements, at least in name. Of course, none of them are legal yet. I'm sure the Trump administration is working on that. But they've also tried to aggressively transform U.S. norms and institutions. And there's been a much more aggressive approach, I think, than anybody expected in terms of changing the personnel at the Federal Reserve. So what is the impact of all of this? Well, I think the impacts are just being felt. And I think we all have to be humble about understanding exactly what will happen, how they interact with each other. But, I think it's relatively uncontroversial to say that all of this will likely test, economic, investment, trade frameworks going forward. There'll probably be winners and losers. It'll widen the gap between them. And this is an effect of just not only the United States, but the global markets.
So, hey, just trying to get a better sense for the actual impact on both GDP and inflation as it relates to this tariff policy. I know that there was a general rule of thumb that you had come out with that suggested that for every 1% rise in the tariff rate, that leads to a 10 basis point fall in GDP and a commensurate 10 basis point rise in inflation. Is that still an appropriate rule of thumb? And if so, how much of that is likely to flow through when all is said and done?
Yeah, no, that's a great question. So we use these rules of thumb. They're certainly stylized, but one of the key issues underlying that rule of thumb is that it didn't assume, or there's no assumption for money that the government collects on the tariffs being rebated back into the economy or recycled back into the economy. And we did get a bill that was passed in Congress, the One Big Beautiful Bill Act. We like to call it OB3, but we did get OB3, which also has a coinciding tax cut element to it, right? Both the businesses and households received generous tax cuts, that is offsetting some of the growth effects from the tariffs and sort of reducing those multipliers. But nevertheless, we still think that there's going to be an effect here, and we think it is going to be felt at a global level as well as in the United States. One of the interesting things about this, actually, is that, I think I talked about this on the last podcast, but trade theory would suggest that whenever you have tariffs that go up, the economic implications of that is that you have, a price level adjustment, so a little bit more domestic inflation, at least in the near term. Foreigners' export prices actually go down a little bit, but then you have trade flows that collapse and you have real incomes that suffer. And the interesting thing is we haven't actually seen any of that yet. And so one of the big areas of focus at our last cyclical forum, and of course of the essay, we talk about this, but why is that happening? Is there some underlying resilience that's going on in the global economy that we're missing, or what's going on? And basically what we did was a deep dive on data on that. And what we found was we think that the reason why the global economy, global growth has actually accelerated over the last several quarters, despite these tariffs, is that you're getting this preemptive behavior. Companies and businesses, households even want to try to get ahead of what they think will be price increases associated with the tariffs. Companies are trying to get inventories in the door through customs and border before they have to pay tariffs. So what you've seen is just this acceleration in activity globally as more preemptive behavior. But we think that's actually kind of dying away and fading away now, and we're starting to see that in the data. So all of this is to say, is that I think there was some of that was basically masking weaker underlying trends globally, and now we're just starting to feel the effects and the economic adjustment that's going to be associated with these tariffs. And we do think global growth will decelerate in the quarters ahead.
So one way, just for me at least, kind of parsing this, we haven't felt the inflationary effects of tariffs. We've continued to have a pretty benign economic environment. So I guess if your two choices, and I know these are overly simplified, but if one choice is beautiful vindication of the administration's economic policy and their fervent hope that tariffs wouldn't be inflationary, or just maybe deferral of some of the ill effects, it sounds like you're still worried about deferral of ill effects, and you think I think you used the term mini bust in the essay that you all published. what should we think about that in terms of its depth and severity and timing?
Yeah, I mean, I think that the question is more about, so we got this pickup in activity, and we have this nice chart that looks at the levels of global industrial production and global trade flows, and you can kind of see this nice little trend that's going up, and the actual data is it accelerated way above that trend. So you had people that were pulling forward activity. Well, what that means, or what it should mean, is that if you are a consumer, you saw tariffs coming and you're like, I want to get ahead of these price increases. I'm going to buy a car now. I know I'm going to need it within the next couple of years. So I'm going to go ahead and do that now instead of later, because I know prices are going to be higher later. Then you don't need that car later. So there's actually what economists call payback. So you get this burst of activity.
Economists call it that?
And then weakness later.
Is that a
maybe
technical term?
Maybe you guys call it that as well. I don't know.
Technical term?
Payback, yeah. That's what we call it. So anyway, so I think the concern here, is that you will get payback. That's not only that this sort of growth impulse fades, but you actually see this sort of period of weakness. Now, that's the global economy. There's actually been some really interesting things about how the U.S. economy is digesting this as well. And when we look at the data there has been some price level adjustment. You can do some pretty detailed analysis and look at the CPI data. And certainly we've seen some adjustment there. But I think the conclusion from that analysis is that that adjustment is happening more slowly than expected, and it's much more, it's much more uneven across sectors. So when we look at the auto sector, we see much less adjustment. Some of the things that have high Chinese import content, like TVs or other, electronic equipment, stuff like that, there's certainly been more, but overall there's not been as much. So the question is, well, why is that happening? And we know the Treasury is collecting revenues, additional excise tax revenues. It's about $350 billion, $370 billion on an annualized basis. That's massive. It's about 1.2% of GDP. So the question is, if companies aren't really passing this through and they're paying the taxes, are they eating it? Are we just seeing it in corporate profit margins and their reduction there? If you look at the equity market and the performance since the April tariffs were announced, it doesn't suggest that corporations are eating it. There's more detailed data that we can look at as well here that the government provides, and it basically suggests that companies are offsetting this. They're defending margins, not by raising prices. They are doing that a little bit, but they're also defending margins by reducing costs in other ways. So travel costs is one of them. The travel industry has gotten really hit by this, but also importantly, labor costs. And I think we've seen that very clearly as well in the labor market data, where you've had a really big deceleration in payroll, net payroll gains, and of course hours worked. So companies are really trying to manage costs here, and then some of the adjustment is coming out in the labor market, which I don't think anybody really expected.
Yeah, we had in last month's pod, we had Dr. Clarida, Rich Clarida, mutual friend of ours, advisor to PIMCO, colleague, partner, and maybe more importantly, former vice chair of the Fed. He mentioned that we might actually be seeing, and it sounds like you guys have completed your analysis and concluded that it's the likely case that you're seeing the real impact of tariffs in the employment market, and that's where we ought to be looking to maybe see the cost that is being exacted on the economy.
Yeah, exactly. And I think, so that's kind of like the macro discussion of it. I think when you think more micro and like what's actually going on, what we think is going on is you have larger companies within the retail space that have the ability to set prices, within the marketplace. And what those larger companies are doing, they tend to be more capital intensive. They can gain from some of the benefits from OB3. OB3 is giving upfront capital expensing. So anytime you outlay money on CAPEX as a company, you get to deduct all of that in the first year. That was retroactive as well. So we think some of these larger, more CAPEX intensive companies within the retail sector, they're benefiting from OB3. Mm-hmm. That offsets their tariff costs, but other smaller companies in the retail and trade sectors don't have that luxury. And so, although these larger companies can hold down prices, they're going to do that to gain market share. They see a real opportunity here, to be real winners. That just means that there's a really challenging environment for some of your middle and sort of down market players. And we think that is kind of that dynamic that also sort of needs to play out. And we need to get a better understanding of that, because if you're a challenging environment, potential bankruptcies and or layoffs need to happen, and we think that's I think it's really about the magnitude of that in terms of the economic outlook, like how much of that is really going to cool the economy even further, and I think that's what the Federal Reserve is worried about as well.
Right, and small businesses still employing the majority of Americans, right?
Exactly.
And not despite being smaller than their bigger counterparts. So let's talk about something else that has a lot to do with scale, that has a lot to do with long-term implications for employment, and we'll talk about technology. Are you a ChatGPT user, Brandon?
I'm a huge user. I can tell you I walk a lot, and I just ask questions all day long. It's actually ridiculous.
Do you?
No joke.
You have a friend.
I know he's actually a really good friend of mine at this point.
All right, that's good. Well, Tiffany, let's talk through what your research on technology impacts included in this year's forum, and maybe some of the implications that the team came up with.
Yeah, I mean, so we are in the midst of a technological investment boom as a result of AI and some of the other LLM and other breakthroughs along those lines. And basically what we're seeing now, the equity markets have been trading these themes for several years, but we're actually starting to see it in the investment data for real. So we've seen a pretty big acceleration in what we would call tech-related investment this year. It's R&D, it's software, it's computers. Now, some of this stuff is being imported. There's a big surge in computer and electronic components that have been imported for this stuff. Data centers actually is not huge yet. We think that's more just getting started. But when we look at the data, basically what it suggests to us is that outside of the AI story, there's very little investment going on in the economy. But the AI story is big enough, at least to to drive more resilient trends within investment. So we're certainly seeing that. And as I mentioned, the equities have been trading this for a while, but it does look like we are kind of in the early stages of the actual investment process. So like I mentioned, data center investment it's ramped up a little bit, but it's still a relatively small piece of the broader economy. But it looks like it's kind of in the early stages of that ramp up period. And of course, when we speak with the folks that the energy experts within PIMCO, they would tell us there's actually constraints to to the energy that these data centers need that's actually slowed down that activity. So all of that is to say is that we think we're in kind of the beginning stages of it, and we think maybe over a secular horizon you could get some sort of boom and bust type of event like we had in the .com, but we think at least over the cyclical horizon, the next 6 to 12 months, maybe even 18 months, these kind of themes certainly have more room to run. And I think as you get broader adoption of AI, we're seeing very concentrated investment right now within the hyperscalers and companies that are associated with that. But as you're getting broader investment, that will result in more R&D, more software spending, in other industries within the economy as well and support investment. So we think we're just in the beginning stages of that, and that'll be an important theme. Now, if you'll let me go on for a second longer before asking me a question, this also, I know it's a long-winded answer, but this also has important implications for the labor market. And I know we were just talking about the tariff effects of the labor market, and I mentioned that larger companies that are CAPEX intensive they're winning here. But to the extent that you can start to replace labor with AI, we think that is also resulting in, some of this labor market adjustment to tariffs, because companies do expect, maybe they're not getting as much productivity now, maybe the technology is new, but they're holding back on hiring potentially because they see this on the horizon. And I think if you squint, you are starting to see within the more job-related categories that AI, can displace in software development and things like that. If you squint, you're already kind of starting to see that. So entry-level jobs in those categories are down.
I mean, like the poor young person that used to have to walk alongside Brandon so he could ask them questions, but now he can ask his AI companion.
Yeah, exactly. And so the other thing I would just mention is that actually unemployment rates for the 16 to 25 age group right now are they've risen a lot higher. Now, some of that is probably cyclical, but some of that is starting to be the technology diffusion and the entry level jobs, it being able to take over for that.
Brandon, Texas is obviously the locus of some developmental effort and certainly a lot of technology focus there and in Austin and other places. How are advisors in your neck of the woods thinking about the AI opportunity? How are they thinking about this boom bust dynamic? I think many of them have been in the business long enough to have lived through some of the exuberance of the early 2000s and late 90s. So I'm just curious kind of what you're hearing from folks down there.
Yeah, it's interesting. A lot of these advisors are actually thinking this is continuing to be kind of a melt-up environment akin to the 1999 pre-2000 arena. And so it may be appropriate to suggest that Tiffany's
with the
spot
equity
on.
market, you mean?
Yeah, with the
Yeah.
equity market. I mean, I think Tiffany's probably spot on in the sense that a lot of the home offices of a lot of the advisors that I'm covering are suggesting that there's still room for equity market upside with the highly concentrated tech names that are making huge CAPEX spend in this particular endeavor. I think they're worried, however, about CAPE ratios being at 37, 38 times and multiple expansion probably not driving things moving forward. So it's got to be continued earnings growth to lead the charge. The question is, how long will that last? And I think that's where I suspect some of these investment implications that will come into play as it relates to where investors should be putting cash at the margin moving forward into some perhaps higher quality bond strategies.
Yeah, I want to talk about investment implications, but I did want to ask Tiffany if we stay in like the realm of the real economy for a little bit. I was listening to, I think it was Odd Lots, and it was an AI discussion, and it was a really terrific conversation, and they were just kind of systematically going through, and Tiffany, you prompted this when you mentioned the energy constraints on data center development. But they were going through segments of the economy that you might not have immediately associated with the AI boom as a casual observer. And there were some that obviously made more sense, whether it was chip processing speeds, and then looking at some of the data storage companies, firms that make hard drives that haven't really thought about. And since I knew who had made my hard drive, 20 years ago, and in my PC, it doesn't work quite the same with Macs these days. And then going through energy and not just energy production, but energy transmission and utilities, and you could they were painting a really good picture of the implications of this massive increase in computing power need. And so I wanted to ask it's been a long build up to a simple question, but can you quantify for us the real economic impact of what we're seeing across these industries? And it sounds like it's enough in your mind to balance out, at least near term, some of the slowing effects that we would expect the tariffs to have and other kind of economic headwinds that we're facing right now.
Yeah, so I think that's right. So you can, there's estimates out there of the potential investment needs, full investment needs that you would need as a result of the new AI. And they vary, but they're in the trillions over the next several years. And basically when you think of slivers, you have the energy and associated infrastructure needs. This is literally laying more wires and things like that to connect grids and whatever else, right? The utilities, what they would need to do to expand, but it also includes the specific data centers, the chips, the whatever the hardware is. But the bigger piece of this is the implementation piece, and that is every firm that implements that will have to put some sort of software, some sort of structure around it, and so just that investment alone is actually the biggest piece of this. So it's real in our minds. In terms of how this broadens out and continues to drive investment growth is really about the adoption piece and how quickly that can happen. And this technology is is being diffused much more rapidly than technologies in the past. So there's actually a really interesting paper for those that are interested in wonky things like this, but it looks at new technologies historically, and it goes back to things like a ship or like a steam engine. And it looks at the technological diffusion of those things after they were created, right? And it took hundreds of years for trains, for ships and things like that after their creation to really be diffused across the economy. Even if you look at computers, when they were first created, it took a number of decades. Well, it looks like AI is going much more quickly in terms of the diffusion there. So I do think there is a reason to be, relatively optimistic that this, the investment trends on this can continue, and that we are in the midst of a transformation within our economy.
Well, if you've got we can do it after we're done here, but we'll get that citation and drop it in the show notes if we can. It does.
Yeah.
It sounds pretty interesting. Should we move to some of the investment implications, or really even just, I think when you guys, as we sit in our forum, as we do once a quarter, and for listeners who haven't heard us go on about this process. It's a meeting that PIMCO's done, throughout its 50-year history, where we bring the whole firm together to talk about the state of the economy, the state of markets, the opportunities, the challenges it presents to us and our clients as investors. And Tiffany runs that process for us. And the Cyclical Forum has a view, as she mentioned, of about 6 to 12 months out, maybe 18. And once a year, we do a Secular Forum, which takes on broader themes and with more of a 5 to 10-year horizon. And so coming out of this process last month, obviously, we're right on the heels of the most recent Fed meeting, or maybe right in advance of it. The weeks blend together, Tiffany. We did it before the Fed meeting, right?
Yeah, it was before the Fed meeting. Yeah.
Okay. So we and then we had the one cut, and of course, I think as you guys sort of put that data point and then everything else we've talked about today in your macroeconomic blender, what did you conclude about sort of the likely path of rates from here? We'll start with rates, and then we can maybe move on to a few other market conclusions.
Yeah, absolutely. Well, so kind of coming back to the implications of tariffs and these various other things. So we think all of these factors have come together to result in maybe inflation upside, at least near-term upside inflation risks from these tariff-related adjustments, being somewhat more contained than I think many people expected. And the Federal Reserve went on hold for the better part of 2025 because of the more elevated policy uncertainty and because of some of their concerns about the price level adjustment. If you get this temporary surge in inflation, their concern was because we came off of this pandemic period of elevated inflation, that you have consumers and businesses that are just setting their inflation expectations, somewhat higher as a result of that. And so the Federal Reserve really didn't want that to happen. They went on hold this year. But what we've learned, and I think every forecaster has to be humble, we haven't seen policy changes like this in a century. So we didn't really know what was going to happen. We could make educated guesses. But what we've really seen is that the downside risks in the labor market are greater than we thought, and the upside risks to inflation are less than we thought. So in terms of the Fed's dual mandate, it's pretty clear that I think there's room for them to cut interest rates. They're also above where they think neutral policy is. So central bankers, it's an unseen rate that's highly uncertain, but central bankers think that there's some interest rate where the underlying economy it can handle it. It's neither accelerating or decelerating, and they think they're still above that rate. So in other words, they are putting downward pressure on activity. And when you have labor market risks that are maybe somewhat higher than you thought, being still in that more restrictive territory, maybe doesn't make as much sense. So we think that was what was really driving the decision to cut interest rates in September. And we think there will be, more cuts potentially coming. October, we have a baseline forecast also for a December cut. Obviously, we'll have to see the data to understand what happens. But then, and that will get them much closer to where they think neutral policy is. If that happens, that gets them closer to 3.5, which is kind of where a little bit above where the median thinks it is. But as we look out to 2026, I think there's actually a bigger range of interesting and potential outcomes. Like we said, the technology investment I guess, boom. How does
Mm-hmm.
that play out? But I think the other question is, and we didn't talk about this as much, but you will be getting some more offsetting fiscal stimulus in 2026, both for households and for businesses. So households, anybody that worked overtime in 2025, you paid taxes on that, and you will get all of those taxes back rebated to you when you file for your refunds in early 2026. So we calculate that on aggregate, households are probably going to save, around $90 billion. That's a lot of
Oh,
money.
wow. Wow. Wow.
That's about on average about $1,000 additional refund that you're going to get in 2026, and some people will get much more than that. So that's a decent amount of money that will provide the economy with some stimulus. So this is in terms of our forecast, we think we are kind of in this weak period right now, but in 2026 you are getting some more of that's going to support the economy. And in terms of Fed policy, I think that makes things a little bit more tricky. If you have inflation that's still kind of hanging above target, because you are getting some pass through of tariffs, and you're getting an economy that's fine, then maybe there's you're kind of near neutral. I think there's more question around additional cuts then. So we'll have to see how things go.
So my question would be, where are we in and out of consensus with either macroeconomic variables or preference for different asset classes or sectors? From your perspective, what's priced in at this point in the cycle, and what is it that may or may not be priced in based upon our views relative to the street?
Yeah, well, I mean, the question that I get from clients, well, at least one of the questions that is reoccurring that I get from clients is do tariffs matter still? Because if you look at the equity market, and you look at the kind of landscape, it sort of suggests that they don't. I think what we would argue is
Tiffany, sorry, I'm sorry to interrupt, but but I'm having a flashback to when we were talking in April, right? And equity markets were in free fall.
Yeah.
And the assumption was that tariffs do matter, that they'll be deleterious to international trade, and the economy will really hit a speed bump. And since then, we've more than caught up what we lost, and equity markets by any measure having a pretty good year. So it really underscores the unpredictability of some of these things these times.
Yeah, and I think that's right. I mean, I think the AI story is clearly also supporting the equity market, and we do think that has room to run, as we were talking about. But I guess when we the other thing I would just say is for tariffs, I mentioned households will receive about $90 billion. That's 0.6 of GDP. Tariffs, somebody is paying that, right? So that is 1.2% of GDP, about $350 billion that somebody's paying, and that is a lot of money. And so there will be economic effects of that. I think when we look more globally, at some of the equity market performance, I think you have to think that some of that possibly was equity markets reacting to this reacceleration in global growth that we've gotten, and so as you get that momentum change, you could have some equity market performance that that lags a little bit versus what we've already gotten. But I guess what we kind of think in scenarios. It's not just a base case, but we think in scenarios in terms of our investment strategies and conclusions. I think what we keep coming back to is this idea that you are seeing these transitions. They are starting to play out. We are in the early innings of this. There is a lot of uncertainty about how it will play out. And then you pair that with the fact that the bond market right now is sort of giving investors a gift of high quality, high yield, at the same time that at least the U.S. equity market, the S&P in particular, has those expensive, elevated CAPE and other valuations. That would suggest to us that building resilience within your portfolio and doing it and not really losing that much yield. I was building a chart yesterday that just looked at equity earnings yields relative to nominal treasuries, and you're not getting any pickup really by investing in the S&P in terms of earning yield over what you would have gotten in a nominal treasury. So when you can build a high quality bond portfolio that's yielding you 6, maybe even 7%, that is a very good way to build resilience within your portfolio. And I would just also say that having a global mindset when you're doing that as well, because there are certainly opportunities in the U.S. within high quality fixed income, but there's opportunities in other places as well. And we think there's a lot of other markets that we see where the central banks maybe have been a little bit more delayed in returning policy to neutral, like the Fed, those markets also look incredibly attractive to us, just from a yield perspective. And these are high quality government bond markets elsewhere in the world.
Yeah, I think it's been a theme for us, this year. And, the facts, as much as, we've talked today about the evolution of trade policy and maybe, the data moving around in terms of, when we think tariffs will hit and what the ultimate impact will be. What you just outlined, that those have been themes for us for much of the last year, because the fundamentals haven't changed that much. Equities still screen relatively expensive, which isn't to say they couldn't go higher, right? Credit. When you say high quality fixed income, I think what we mean is fixed income that doesn't have a lot of credit risk associated with it, especially corporate credit risk, which, aligned with our views on maybe stocks being expensive. We think corporate credit is relatively expensive. We think that in the public markets, we think that in the private markets. And so of course that you could say, oh, it's PIMCO. I'm listening to a PIMCO podcast. Of course they like bonds. Like, it'll be news when we tell you not to buy bonds. And that's
Yeah.
that's a fair criticism of us. And we should probably own that and reflect on it. But putting our own biases aside, you look at the numbers, you look at with a pretty objective viewpoint. Like you just said, the earnings yield on the U.S. corporate sector doesn't get you more than a treasury at this point. That's a pretty rare occurrence, and it usually points to a fair amount of value in fixed income.
Well, it's not just that our views are that high quality bonds are worth their salt, but it's also that flows are materializing in that direction as well, Greg. Just in the last, on a year-to-date basis, over $370 billion have gone into bond solutions. And you compare that to kind of non-traditional equities being the next closest, that's only $60 billion. So I think the market is recognizing that bonds are offering a better value. Advisors within the Dallas market, by the way, are also recognizing that bonds are offering certainly a more attractive value proposition versus cash. What they're having trouble with right now is that unless cash rates are actually lower than the yield on the ag, it's hard to get their clients to move out of cash. And yet with this most recent rate cut, they're finally seeing the ag out yielding cash. And they're, instead of rolling T-bills or rolling CDs or staying in money markets, they're actually going to their clients with proposals about going into any component of the fixed income markets. And which of those markets make the most sense to own when the Fed is cutting rates? We've done the work on this. Literally any fixed income sector outperforms cash when the Fed is in a cutting cycle. And if there's 2 more cuts this year and 1 or 2 more in the first half of 2026, which seems to be priced in, then that's the place to be. The advisor community is recognizing that. Investors are moving in that direction, right? And so in that effort, we have a solutions team that puts together a portfolio, the average advisor portfolio. Imagine just taking thousands and thousands of advisor fixed income portfolios and compare it to what we would be doing. The typical advisor, they have a duration profile within their portfolio of 4.5 years. The typical advisor has 22% of their fixed income model allocated to cash and short-term strategies. The typical advisor, a hell of a lot more exposure to investment grade spread duration. So I think, what we can do is, if advisors want to come to us with their portfolios, we can compare their portfolio to how we're currently positioned. Then we can make some suggestions on modest modifications that they can make within their portfolios to kind of close that gap a bit. And what we're noticing is, you go up in quality, you go up in yield at the same time. It's very rare to have your cake and eat it too.
A lot of that's detailed really nicely in the report, which we'll link to in the show notes. There's so much more in there that we're not going to have time to get to today. It's a really good read. It's really nicely put together, and has some other implications for what we think about international markets, private markets. But with that, let me just say, Tiffany, such a pleasure to have you back on the podcast. A little bit more room to think about things, in this episode than we were in the midst of what was going on in April, and just appreciate your the level of detail that you guys go into, your ability to synthesize everything for us and for our listeners, and you will be invited back.
That's great. Well, thanks for having me. Maybe if I could just say one more thing
Yeah,
all
please.
of the bond market excitement that we're sort of telling our clients. I think we've been saying this for some time, and it was a little bit of a leap of faith, a little bit. I think it wasn't maybe as obvious for people that elevated yields would actually get you decent returns. But if you just look at the performance last year of bonds, I mean, they basically have done what we've suggested that they're going to do. Elevated yields are a very good predictor of future returns within the bond market, which is, I guess, obvious. But now that's actually proven. You can literally see it in the returns data. So I think that's another reason to be excited about the bond market.
All right, terrific. A great note to end it on. Thank you both for joining us, and we'll see you next time. For everybody listening, thanks for tuning in to another episode of Accrued Interest. We're so delighted to bring this to you each month, if not more frequently. As always, please visit us at PIMCO.com. If you identify yourself as a financial advisor, you will be taken to Advisor Forum. Like Cyclical Forum, which is where we got the name from, Advisor Forum is your one-stop shop at PIMCO to get what you need, the information, the tools, as Brandon mentioned, whatever you need from us to help serve your clients better, make your day a little more efficient, a little more practical, and send you on your way. So with that, until next time, thanks so much for listening.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures.